Do you know what separates a failed business exit from a highly profitable one? Do you want to maximize the value of your business? The Business Exit Stories podcast is the solution. Through a collection of stories told by the business intermediaries who facilitate those transactions, you'll receive the key takeaways from successful and, yes, some not so successful business exits. Now is the time to begin to position your business for an exit by implementing key strategies designed to maximize your enterprise value and help you achieve an exceptionally profitable exit.
Today we have with us as a guest Shanyn Stewart, who is an exit tax planning specialist. Shanyn works with entrepreneurs who are in the process or will soon be selling their businesses, developing a tax strategy to help them minimize or in some cases totally eliminate taxes they will owe when their business is sold. In the first transaction that Shanyn shares with us on the podcast is a sad story of a tax plan gone awry. Although a comprehensive tax plan was painstakingly crafted and designed, Shanyn's client, for some unexplained reason, but likely triggered by the pandemic, went dark on her for nearly 9 months. Less than a week before the sale was to take place, the client called and asked if everything was ready to go because the closing was scheduled for the following Monday. Needless to say, there was shock in Shanyn's team and with her. She carefully explained to her client that a significant portion of the tax planning strategies that have been crafted couldn't be done and implemented in a matter of days. Listen and find out what happened in this situation. This is Marvin L. Storm with the Business Exit Stories podcast. Today we're here with Shanyn Stewart. Shanyn, would you take a few minutes to introduce yourself, talk a little bit about your business and where you're located?
Hi, my name is Shanyn Stewart. I own Advanced Accounting, and we're actually located in Michigan. However, 80% of our clientele are actually all positioned around the world, and we help clients and basically entrepreneurs to actually pay the least amount of taxes while they're running their business. And our superpower is actually helping them on the exit of that business to pay the least amount of taxes legally possible as they sell and exit their businesses.
Well, this is going to be an exciting episode. Primarily, I think the antenna is up on most of the audience here who are business owners that haven't thought a lot about selling their business up to this point in time. And now that they are starting to zero in on some of those issues, such as taxation. And something that may not have been at the top of their priority list in the past certainly is going to be in the future, because I think most everyone is expecting some changes in how capital gains and all of those years of hard work are going to be taxed as people look to monetize that hard work in the future as they look to exit their business. And so this should be an interesting episode for our audience here. So why don't we kind of jump in and chat a little bit about that now. So why don't you share a transaction with us that may have had its challenges and maybe didn't come out as well as anticipated and maybe could have been done a little bit differently, and kind of share a transaction that has those characteristics with us here as we talk a little bit about taxation here and people exiting businesses or selling other assets.
Definitely. So we just had a transaction that closed in February, and we had started working with this gentleman about 1.5 years ago. So when we bring individuals into our process, we take them through a discovery process, getting really the understanding of what their businesses are. Oftentimes we have serial entrepreneurs, what their businesses are and what they want to have happen or accomplish on the back end. So we had an individual who had engaged us, and we were engaged for about 18 months, and we had gone through the discovery process and really mocked up a really solid plan that coupled several different planning strategies. So we were working with a gentleman who was a real estate investor. He was actually in a state that had no taxation, so that's always wonderful. But we still were dealing with the federal taxation. And he was selling a whole complex of apartments, and it was a $5 million deal. And so it was quite a large deal, especially since he had also utilized a cost segregation study with some of the advanced planning we had done a few years ago. So we had a
Why
lot.
don't you just talk a little bit, because cost segregation is something that really applies not only to real estate, but other types of assets. Why don't you just briefly share with our audience, in case they aren't familiar with that term or the strategy?
So a cost segregation study is a method that is utilizing a study of the assets. So oftentimes we see it in the real estate market where we actually bring in an engineering company to actually look at all the different components of that building. So everything, if you were to buy a building today and it was a commercial building, you would purchase it and we would depreciate the whole building over 39 years, meaning we would take a fraction of that original basis or original purchase price and we would actually deduct a portion over 39 years. With a cost segregation study, we're actually coming in and we're looking at different key areas. Oftentimes, we're looking at 13 different areas. And there are different components within your building that depreciate on a different timeline. They have a different useful life. So for instance, carpeting is not going to last 39 years. And so we can accelerate the depreciation on certain components of your real estate, your building, over a time period. So we actually go through and we do a study and we look at different components of, different upgrades that were made to that real estate. What component, what percentage is HVAC, carpeting, like just down to the nuances of those different things that are inside that real estate. We're able to give them different useful lives based on the percentage that are actually housed inside that real estate. So you're able to actually accelerate depreciation over usually about a 5-year period. So that means you get a higher tax write-off, better cash flow if it's a rental property. And so it basically means more money in your pocket quicker up front from that standpoint. But the caveat here is when you go to sell it, you got to recapture that depreciation. It means you got to pay taxes on it at the sale. So they're a really great planning technique. I think it's one of the most underutilized techniques, especially when I have a lot of real estate investors that come through. That's one of the first things that we do is to help them with a cost segregation study.
So a business owner that had maybe owns his building or something could apply the same strategy as this gentleman that you're working with here, the real estate investor.
Definitely, exactly. So this gentleman had come into our system and we had spent 18 months. We had actually come up with a very unique strategy for him that was going to be a partial 1031 exchange and a monetized installment sale. So we kind of used several different strategies to come up with a unique plan. And then COVID hit and he just went dark on us. So
let me get the context right here. So you'd been working with this individual. He knew that he was going to be selling a year or two down the road. He had this on his radar and he had planned for it. You had been working with him and you and your team had developed this strategy and kind of teed it up for, the actual point in time in which he would be exiting. And it was kind of all laid out. So he had gone through the pre-planning process, kind of accepted your strategies and everything. And then all of a sudden after COVID hit, he kind of disappeared off the radar. That's what you're saying?
He did. And it was a strange time for us all, really. And so February comes around and I get an email on a Thursday afternoon.
February of this year, meaning
February of 2021 comes around and on a Thursday, I get an email that says, "Hey, I'm going to close on Monday." And I literally, like 3 people popped their head in my door and said, "Did you get that email?" And I'm like, "I did get that email. We've got a problem." Because we had done all of the planning, but there was things behind the scenes that had to take place. Developing the plan is great, but then there were things that, from the lawyer standpoint and the escrow closing standpoint that had to be in place to make the deal all come together. And so he ended up closing. We could not do 100% of the plan that we'd put together. We were able to do a fraction of it. But it was at a substantial cost to him. Now, he's still my client because he's a real estate investor and he's going to do more of these deals coming up. And, he was like, I kind of lost my head over the whole situation, but it'll never happen again because it costs me tax dollars.
Well, I would imagine when you're talking about things such as a 1031 exchange, those things can't happen on the dime. I mean, that has to take planning. There's time criteria that has to be in
Mhm.
place that you have to meet. And it's not something that can, take place over a weekend.
No, it couldn't. And we actually went back to our client and said, can we can we press out the date? Like, we can have some of these things happen, but we can't, here's the nuance. When we're talking about exit strategies, there's so much that you can do, but it has to be properly planned. It just, you have to make sure you've crossed all your T's and dotted all your I's, and you've done the planning from that standpoint.
Well, that not only holds true for, the tax side of the equation, it holds true on a lot of other aspects of, positioning a business for sale. The taxes, which are a significant portion of what an exit plan should entail. But, you have to really plan and anticipate and put things in place far before you actually get to the closing table. And in your situation with the technical area of tax planning, it's even more important.
Definitely.
So what would be the big takeaway here? I mean, I have to believe that you're saying that you had, I don't know, 5 strategies all teed up that would, significantly reduce the impact of taxation that would have on his particular situation. But what you're kind of telling me here is that you maybe got 1 or 2 of the 5 that actually was able to come to fruition. Is that what you're telling me?
Exactly. We could not execute 100% of the plan given the time constraints of when they were going to closing. And we probably, in my mind, now I personally, offered to call the buyer and even throw myself on the bus on the at the mercy of the buyer to say, I need a little bit more time to make this happen. But the seller was worried that the deal would fall through if we tried to push off the buyer just even a few weeks. So.
Well, I would imagine that there was a significant check written to pay the taxes that he probably didn't have to write if he had been a little bit more dialed in and called you a few months before.
Definitely. And that's the unfortunate, because here's the thing. There are legal caveats. We call them loopholes. We like to call in the professional world, we call them caveats. There are definitely caveats within the IRS code that give us the ability to pay the least amount of taxes possible. But number one, you got to know what those caveats are, and you have to know how to utilize them and how much time it takes to actually implement them as well.
Mm-hmm. Well, so the big takeaway here is really you have to not only do the planning, you actually have to allow time for the plan to be executed as you approach the actual closing, because there are statutory time requirements and there are things that actually have to take place in advance and cannot be implemented at the last minute. And in this particular situation, some of the strategies and techniques and caveats that you were planning for just couldn't happen. And so they didn't take place. And the penalty for that type of circumstance was you ended up writing a pretty big check, or this gentleman ended up writing a pretty big check to pay the taxes.
Unfortunately. So many of the planning techniques that we utilize have those time restraints. And also, so one of the things that we run into a lot is that we'll be doing planning, and we'll be educating on the different strategies that exist. And all of a sudden someone will call me up and say, I have someone who wants to give me a letter of intent. And one of the things that we always have to remember when we're doing our planning is some of our planning techniques that we utilize, once we have a letter of intent, they're no longer valid. We can't use those strategies. So again, when we're talking about any type of planning for taxation, exiting of a business owner from a tax standpoint, we need to be kind of forward thinking. We need to be looking down the time horizon. Am I going to be selling in 12 months, 24 months? I can't have you call me up on a Thursday and want to close on Friday and have everything, or have a letter of intent already in place, and us actually be able to be the most effective that we can be as tax planners.
So I guess the takeaway here, to reiterate, is really planning is great, but you have to allow for time of execution and then actually execute on the plan.
That's correct.
Well, that's a word to the wise out there, I guess. Look at what you can do and then execute on what the plan that you actually put in place is.
Mhm.
So why don't we move on to another transaction that you might be able to share with us that'll have a different kind of spin to it or orientation on doing some planning.
Well, definitely. We had a partnership that came to us. It was an e-commerce partnership, and it was a $10 million deal. And it was a pretty amazing deal. They, being an e-commerce business, they actually had some inventory and some other nuances from that standpoint, but they actually had 4 partners. And what happened inside this planning, so again, they engaged us about a year before they were actually going to sell. Things were going just really well. We were talking about strategy, and then all of a sudden, we had some pushbacks from some of the partners. The partners couldn't agree on what were the metrics going to be when they would actually sell the business. So, one partner was like, well, I think it's a $20 million company. And one said, well, no, I'm willing to take, 8 million. And the other said, I'm willing to take 12 million, so that we couldn't get consensus of what the metric was. We wanted to list it with a broker that we knew, but we couldn't get them to actually agree on, number one, what was the price? What was the metric? What was going to trigger the sale? Everyone knew that they really wanted to sell, but they didn't know what the actual sale price that they were going to be comfortable with. And then when we got down into the nitty gritty, I realized as we were kind of going through our discovery processes, there was no partnership agreement. Nothing was in writing. This was all just basically a handshake, which is great.
I think from my perspective, I've heard this story, this type of situation over and over again. Mm-hmm. You start the business, your friends, and the business grows and takes off and things are going well and you like each other, and you just don't anticipate that there'll be a time when you may not agree and it isn't documented in what the process is going to be. So I'm just really curious that when you have 4 different people, generally it's 2 people in a partnership a lot of times, but when you have 4 people, it's kind of exponential in nature almost, because they aren't the same age, they have different points in their life, different attitudes, different goals and objectives. So how did this kind of unfold?
So as we were going through our discovery process and our planning process, and of course I asked to see the partnership agreement, and everyone said, well, this is just gentleman's agreement on a handshake. I started to kind of ask different questions. So I'm always like, let's ask different questions. So what happens if one of you dies? What happens? Tell me. Well, technically you're in business with the partner's wife, and then the other individual wasn't married. So now you've got an estate issue. What happens if one of you becomes disabled? What happens if one of you wants to just exit the business and you're just tired of dealing with, no one wants to sell and you don't want to work anymore? How do you frame all of these different things? And a partnership is kind of like a marriage. Oftentimes we'll have a premarital contract, a prenup, that kind of talks about what happens if this doesn't work out. How do we all kind of leave the arrangement unscathed? And so just like in a partnership or any business agreement, how do that partnership agreement actually talks about those things, like if do you have a buy-sell agreement? What happens if death, disability? What happens if I want to sell? And so we had to kind of do the planning in reverse. We kind of had to, this partnership agreement should have happened prior to them getting into business, but now we were at the doorstep of listing our business with a broker, and we had to kind of hash all of those different things out. And ultimately, as the mediator, as my team as the mediator, we were really able to kind of start to flush out, the different personalities. Because everyone started fighting. Everyone, now they're friends and they were golfing together, no longer golfing together because they're just upset about different things. And ultimately, we came to the metrics that were needed to actually what they all felt comfortable the business was worth, with the help of the business valuation and the business broker, and they were able to list their business.
It sounds here, just to jump in here for a minute, that you had really 2 things going on here. You had really the dynamics of a partnership to get everyone on the same page. And then when you incorporate, the tax planning issues in this, you almost had to, plow up the where the road was going to be before you actually laid the asphalt down, which is the tax planning.
Exactly.
And in this particular case, you had to do a lot of preparatory work before you even got to the tax planning issues, or at least that's what it sounds like to me.
No, definitely. And it's something I run into this so often. So I was working with another client just last week, and two of them are in California, one's in Chicago, one's in Florida, and they have a partnership. And I said, look, can I see the partnership agreement and the buy-sell agreement? And everyone looked at each other on Zoom like, oh, well, we just went and formed an LLC in Texas. We didn't do anything other than that. And so that's my cue right there to take a step back and ask those questions of, okay, we've got to have a solid plan in place, because they want to sell their business within 4 years. And so before we get to that ability to actually do any type of tax planning, we've got to do all that foundation pieces as well. And it happens every day. I just had a call earlier today with a couple of guys who sell equipment online, and it's a gentleman's agreement.
Mm-hmm.
And so
in this particular, go ahead, sorry.
No, I think it's more common than not to have because it's not nice. It's not fun to talk about some of those things. When we're talking about having a, plan, again, this all comes down to planning and being proactive in our planning. And sometimes those things are hard to talk about, like, especially, and no offense, but 90% of the people I deal with are men. And so oftentimes they don't like it when I talk to them about what happens if you die or if you become disabled, from that standpoint. And so, it's something that it's not nice, not fun to have to talk about these things before we even get to what they just want to sell their business. They're like, Shanyn, we don't care about all this other stuff. We just want to sell our business. But it can complicate things in the transaction if we don't have everything really clearly, all of the nuances and expectations already preset.
So in this particular situation, as you kind of laid this groundwork and got them to the point now where they're, can actually focus on the tax planning, and you indicated that it was a $10 million transaction, mm-hmm. and kind of what type of strategies did you put in place, and what type of deferral or tax savings were they actually able to realize, and as you structured this transaction for an exit from a tax planning perspective?
Right. So it was a $10 million deal. They had no equipment depreciation that we had to recapture. So if we would have done no planning at all, they would have walked away with about $7.5 million. So they would have lost about $1.8 million to taxation if we had not done any type of planning whatsoever. What we were able to actually do for them is a deferral strategy. So we did a monetizing loan coupled with an installment sale, and they actually walked away with about 24% additional cash in their hand over no planning at all. So they walked away with about $8.8 million at the close of this deal.
Well, that's a significant difference. It's well worth the time to at least think about this, isn't it?
Definitely. I mean, it put about $1.7 million more in their hand than they wouldn't have had. I mean, and so that's a huge chunk of change and for anyone.
And so in this situation, if you're looking at a takeaway from this transaction, obviously you have the issues that revolve around having a partnership agreement and having those types of things in place. And then you can move on to the more substantive dollars and cents of what's actually going to be realized when you actually do sell the business. What would be the big takeaway, something our audience could hang their hat on from this specific situation?
Well, I think it's never too late to do planning. You could, these individuals had been in business for a number of years together, and it had been a glory. I mean, they did very, very well for themselves. And I think it's never too late to do the planning. It's never too late to be proactive and to really make sure that you have everything in alignment. I mean, it's just like when I'm working with a client and we're talking from a financial planning standpoint, and I ask the question, when was the last time you updated your will or your trust or your beneficiaries? This is something as well, like when we're in a partnership with one another, it's never too late to do that updating that may need to happen prior to a big event like a sale.
Well, even more importantly, when you're actually talking about 4 different partners, you can envision a scenario where a partner may have a different opinion on the price that's going to be accepted, may have a different opinion on who the actual buyer should be. They may have, the type of buyer that's actually coming to the table and what the plans for that buyer has for the business and why they're purchasing the business. Some of the partners may be motivated, entirely by the net result of the sale and could care less or care a lot less about what's going to happen to the business, while another partner may care very deeply about what happens to the business and be able to take less money. And if there isn't a decision matrix or methodology to get past those things, sales can collapse over disagreement on those basic exit terms. Definitely.
You hit the nail right on the head.
Well, that's a good takeaway for those in our audience who are in partnerships. I think what Shanyn said here, it's never too late to do planning. Even if you've been in business for 20 or 30 years with a partner, when you're kind of rolling up on that exit time, time to put things in writing so that your exit doesn't blow up at the last minute because of a partnership issue or a difference of opinion. The amount of time and dollars spent to get those things taken care of in advance of an actual sale is probably money well spent and time well invested.
Definitely.
All right. Well,
thanks for listening to the Business Exit Stories podcast. For more information or to reach out to today's guest, visit www.businessexitstories.com for more details. Please subscribe, rate, review, and share this podcast from your favorite podcasting platforms. And remember, maximizing business value at the time of exit doesn't happen magically. It takes planning.